Everybody, it's me, the Einstein on Wall Street, from the balcony here at the New York Stock Exchange. It's a beautiful day. We're on the corner of Broad and Wall Street, a corner of walk and don't walk, a quarter for 250,000, 250,000 with 3 A's. Take them. We're talking old school here. We are here, the beginning of the fourth quarter. We closed out Q3. You know what? There was absolutely no seasonality of August and September at all. This market closed out strong. We are already in our 33rd record close of 2025. 2025 has been an extraordinary year. Virtually everything that could be thrown at a market has been thrown at this market this year. We've got a couple of global wars. We've got tariffs. We've got interest rates. We've got, high highs, low lows, absolutely everything. The talk about the R word, all kinds of, literally, from wonderful things to disastrous things to absolutely everything. And with all that being said, obviously one of the biggest overriding factors that's really played the biggest role here in 2025 was tariffs, right? And the new administration and all that went into that. Anyway, I don't need to go into a whole tirade on how we got to where we are, but we're on October. I'm still in August. I'm probably still in August of 2024. That's not your problem. That's mine. Anyway, we are in October 8th. Okay, October 8th, beginning of the fourth quarter. And with all that's going on, the market is still trading at record highs. I believe if things close out the way they are right now, we opened at lower left. We look like we're closing at the top right. That's one of those spectacular trend days. The Dow right now is up 184 points, approaching Dow 47,000, which we hit intraday a couple of days ago. We've yet to close above that landmark threshold. We are at 67 and change on the S&P. 7,000 is just a couple of inches away, and my gut is, I'm not here to predict the future, my gut is by year end there will be a 7 in front of that number, and that's extraordinary. How did we get here? What are we doing here? What does the immediate future look like? And what can we say about where we are in the bigger picture, right? Economically, geopolitically, all that, all the things that go into what make a market and what make the economics of a country, at least, and the globe. There's nobody better to talk about this amazing expanse. And the biggest story of all, boom, is my man, Tim Anderson. Welcome, Tim.
Always great to be with you.
Thank you. So let's talk for a minute.
Sure.
We closed out, you and I closed out Q3.
Yeah.
We talked about it, how we, and I think the overriding topic of what it was what could the market be, what could we throw at this market that would dislocate this almost irrational enthusiasm that's around the market? Or why is the market still, with everything going on, still trading at record highs? And we went over it. We checked off the boxes, right? A lot of backroom diplomacy going on while we were focused a little bit on the Middle Eastern war. We know that, Besant and Lutnick and the president and the team were making deals with Japan, UK, EU, and all that. That was a big factor. We talked about that, you and me, back February, March, April. What would it take to get this market back on track? Those were a big factor. Earnings, lifeblood of the market, 80% S&P, beat guidance absolutely in our range, not like Q3, not like Q2, where we couldn't, because of the tariff uncertainty, couldn't even give guidance. So we ended the quarter spectacularly, right, at record highs across the board. And even with some uncertainty and a lot of whatever, we still know money on the sidelines. Right, so let's pick that right up. We are here trading at record highs once again, and a government shutdown, which historically would have a negative impact on the market, it's still here. We're in day 8 of it, and it's had absolutely no effect on the market. Give me your impression on that.
Well, we're certainly not going to get tripped up by any bad macroeconomic data, because none of it's coming out right now due to the government shutdown.
The data is happening, but we don't know about it.
Right.
Okay.
But it certainly feels like, although the job market might be slowing down a little bit, it's not falling off a cliff.
Right.
We're going to start to get meaningful earnings reports this Friday.
Very soon.
When
Correct.
the banks start to report,
right?
And then we'll get other big companies reporting, next week and the week after that.
We're going to come into Q4 as we usually do.
Look, everybody wants to know, well, how is the market overextended? Is this a, bubble? Is this how high? And I will just give a very simple answer that I learned from a very good trader and very good technician decades ago.
Tell me.
Look, right now, the market's going up until it's not.
Correct.
Okay?
And that's what markets do.
It sounds like a flippant answer, but it's what's happening.
Yeah.
We're going up.
Yeah.
I don't know how high we're going.
Exactly. We will go
don't
up
have
until we're no longer going
a
up.
target like
Or a
equity
crystal ball.
strategist would
Right,
have.
right.
But it's clear that the market is going up.
Unquestionably.
Okay.
Day after day after day. We've only had 3 days, sorry to interrupt you, but literally in the last couple of months, we've only actually had 3 days of what I mean, I don't even, they were nothing burgers completely.
Right.
3 days where the market was in the red.
Yeah.
And those, I couldn't even call them pullbacks or sell-offs. They were so shallow in their breath of negativity that, you know what, and even on the days that we were red, the advances versus declines were positive. So it was meaningless.
With the Dow between 46,000 and 47,000, I mean, clearly, we could have a pullback of 500 points. What would that be, 1%?
Right,
It
and it would be
wouldn't
meaningless.
really mean a whole lot unless we got 3 or 4 or 5 of those days in a row.
Back to back
So,
across the board, yes.
Look, it's just the momentum is behind the market. There is still, we didn't even talk about this 2 weeks ago. There's $7 trillion in money market funds, and interest rates are going lower because the Fed is now in a rate cutting
cycle, right, which I've been using.
So
Thank you for that.
as the interest rate on those money market funds decreases, that $7 trillion that's in there, some of it's going to say, okay, I'm only getting 3% now. I was getting 4% a few weeks ago. Maybe I want to put some of this money in the stock market.
No problem. Sorry.
And so,
so
totally. This
totally.
is just, that's just.
So you're
more
saying there's $7 trillion in
potential-
money market funds
Yes,
that is making,
that's,
and so if the interest rates are at 5.5 or whatever it is, 4,
Right.
5 and a
Maybe
quarter,
they're making
what are
5.
they making? They're making 5.
Maybe
Okay.
after another
so they may
couple of cuts,
reevaluate
they'll be
at this
making
point.
3.5 or
Right,
4.
right, exactly.
That's just more potential fuel for
I didn't even
the
think you,
fire.
absolutely, yes,
in
yes.
terms of
Money
stock
being
market
transitioned.
appreciation.
Go on, guys. Sure.
So, that's just one.
That's just one factor, one component
one factor,
of this
but
amazing,
one
right.
very meaningful component
Yeah.
of what is potentially fueling the market to continue to perform well into the end of the year. Obviously, we want decent earnings. We want some constructive comments
And guidance, right?
And guidance from
right.
companies,
Right.
And then we're just, we're there. I mean, the market is doing what it's going to do in an environment where it's dealt with a lot of bad news and
Right.
some uncertainty,
And it's been as
now
resilient as a market can
Yes,
be.
yes.
Right. So, look, you are absolutely right. The market, we keep saying, like, what could you throw at the market? You know what? Everything has been thrown at this market in 2025, and we had a mini crash February, March, April. We've had a new administration. We've had some global wars. We've had the whole tariff question. We've had literally our global trading partners have been tossed into it like in a mixed martial arts octagon, because to the point where we were like, we went up against it, we went at each other's throats at one point in the middle of all that, and we've come through everything.
Yeah.
We know that markets can handle anything except uncertainty and surprises, and even with all this uncertainty and surprise that we've had in 2025, we've got through it. We are trading at record highs, and it is not a bubble. And look, we've lived through many bubbles. We were just talking that Tim and I have been around. We were not, unlike some may think. I wasn't here in 1929 for that crash, but we've been a crash. We were here for the crash of '87. We don't use the term crash lightly. We were here for the crash of '87, for the 2000 internet bubble, for the financial crisis of '07, and obviously for COVID, and then what I call the mini crash, which was February, March, April of this year. I'm calling it a self-inflicted. We're just dissent amongst the ranks on this, but a self-inflicted economic Armageddon due to the way that the information was disseminated by the administration around tariffs. But we're not going to get political on that. So we're here in a spot, and you just said it. I always joke, people used to mock me on the floor when I'd say the market's doing what it wants to do.
Yeah.
The market is telling us what it thinks of the information. When the Federal Reserve has a meeting and they either cut rates or lower or raise rates, whatever cycle we're in, and now we are, as you've helped me out so well in this, we are now embarked, as of the last Fed meeting, on an interest rate cutting cycle. And you did give me a little bit of historic data saying that interest rates cutting cycles that last. What is it? What is that?
When the Fed cuts, the history is that there have been 12 times in, let's say, recent history, where the Fed has had a series of rate cuts when the market
sort of
was
embarked on the rate
at
cutting
or very
cycle.
close to an all-time high. Because a lot of people would say, well, why would the Fed cut rates? The market's at an all-time high. Well, there are pockets of the economy that have really been suffering from high rates, like the housing sector.
100%.
So, and the Fed can be concerned about a little bit of weakness in the job market, and some of that may be
and we've seen that,
exacerbated a little bit by the AI phenomenon. Having some companies maybe cut back a little bit on some hiring,
possibly
of people, low-level
we're seeing the impact
people,
of tariffs.
mid-level management people.
That is also,
and the impact of tariffs is still not 100% clear.
Yes,
so,
that's true.
But when the Fed cuts rates, when we're at or near an all-time high, 12 out of 12 times the market's higher 6 months later and a year later.
As much as 16%, I think, is the number you threw out.
As much as 15%. So that's a
that's a light at the end of the tunnel.
Constructive environment for us to be in. Not only is the economy reasonably healthy, almost no one is visiting the recession story right now.
Not at all.
And we have interest rates coming a little bit lower. It's going to help pockets of the economy that have been suffering from high interest rates.
Yes.
And look, a lot of that is because we had abnormally low interest rates
for an
extended period of time. And that put a lot of people, tens of millions of people, in mortgages with maybe 3.5% to 4%.
Right.
And if they were to sell their house and buy a new mortgage, and some of them are probably ready to do that just where they are in their own lifespan cycle, they would have to incur a 7% mortgage.
Right, so
and
they're
that's
not.
What's freezing up the housing market.
So new housing sales are probably at a low.
And construction, and et cetera, et cetera.
Exactly, and building. I mean, the bottom line is higher interest rates for longer. Think about this. We were at zero interest rates for a while. Then we had COVID. We were forced to print $3 trillion over 3 months. Literally, we got back to even by August. But we ended up having 18 consecutive interest rate raises over that period of time until we got up to the 5 and change. Right? Then the cycle turned based on inflation and all that was going on with all that, and then we have to, the way the economic cycle is, you raise them, to offset what you've done as far as printing money
goes. Once you get to an equilibrium, then
you start cutting and doing.
Because the Fed wants to balance out inflation with the health of the job market, and they feel right now, correctly so, although they're a little bit late, that there's more risk to the job market than there is to there's more risk to the job market weakening than there is to inflation going higher.
Yes.
So it's almost near certainty that they're going to cut at the end of October. This will be the last, toward the very end of the month. And then they'll have another meeting in early to mid-December.
So we've only got 2 meetings left for the year. So we could either do 2 25s, we could do a 50 and a 25. If we go back to 2024, we waited all the way to September.
We did a 50 and then 225s.
We did a 50 shock and awe. The market responded in an aggressive sellish way because there's that paradox that when you do a 50, when everyone's been expecting it for a while, and we actually had a missed opportunity back in July and of course in August after the crash of the Japanese market last year, that 50 got people thinking, well, maybe the Fed knows something we don't know. Maybe the market is softer.
Maybe the economy is worse than
way worse, and that's why we're doing the 50. But net, by the end of the look, we did the 50. The market was able to digest it.
A year ago.
A year ago, right?
Yes.
We were able to. The market was able to. The initial reaction was negative, down 1,000. In fact, we were able to bounce back, and we closed out the year up 23.8%. Right. That was 2 years back to back. 23 and
plus,
24,
which is why a lot of people said it would be very unusual for us to have a third year like that. But
how much are we up for the year? Are we up 15?
I don't have those numbers
right at the top of me,
but we're having a much more stock market appreciation than almost anyone would have anticipated,
100%.
given the fact that we'd had two 20% up years in a row.
And we had a 20.8% sell-off in
Yes.
February, March, and
Right.
April.
Right.
We
And
made
that-
it back and then some.
And that probably helps where we are now, because a lot of allegedly smart institutional investors and
Right.
hedge fund managers were too slow to reload and
They were actually
take their
selling.
equity exposure back up to participate with a
Yes.
rally
Yes.
after that April sell-off, and then they had an underperformance for the first half of the year, and they were not going to risk an underperformance
Right.
in the second half of the year.
So that's in
they've
fact-
been fully invested and pushing things.
Correct. That's why, in fact, and you will appreciate this, that on the close of the last day of Q3, a few days ago, in fact, at 359.50, we ended up having a $4 billion buy program that came in on the last day. Now, normally on quarters where you've got a really robust performance,
Yeah.
you would more normally have profit taking in the last few days or the last week of the quarter, because people are taking a little bit of profits off the
Yeah.
table because they're going to be judged by their P&L on that day.
And
On the-
we did have a very mild correction or
Shallow,
some
yeah.
selling in a lot of overperforming names. And
For
the
instance, where'd you see it?
In a lot of the AI-driven,
Right, there was a
rock
week or
and
so, you're
roll
right.
tech type
Yes,
names.
yes.
But the reason I think we had that is because a lot of managers have in their charter that they can't be over a certain
Overweight.
percentage. They can't be overweighted
On the mags.
in one sector or
Right,
another.
right. And they were so heavy in Mag
because
7.
of the big price appreciation
Yes.
in the third quarter of the AI-driven tech names,
Right.
they became overweighted
Yes, yes,
in
you're
that. So they
absolutely
were
right.
peeling out. They were
Yep.
they were just doing some portfolio adjusting.
And we saw that because
in a lot
even though
of
the market
names.
was not selling
Yes.
off, we did have a couple of weeks
No,
there
the-
where the Palantirs were getting hit,
yeah,
and the Tesla
The
and
big
the
averages
NVIDIAs.
were not
Yep.
getting hit that much.
Correct.
But the higher performing stocks were having some selling in the last couple of weeks of the quarter, but that was very healthy.
Correct. And look, and you always alert me of this, which is one of the wonderful things about Tim, is that he's always looking in the nooks and crannies. If you look on the days that we were either up or down, the advances versus declines were fairly even 50-50,
Yeah.
which shows that there was no basic, they weren't dumping stocks. They were
No.
rotating out of
Yes.
some of the outperforming
Yes.
names and getting into other ones. We also
They-
saw that highlighted by the Russell 2000 hitting
Yep.
a record high for the first time in 2.5 years.
Right.
Which is a lot of the small cap, mid cap.
Which helps extinguish the possibility of a recession, because the small cap stocks will get hit the hardest if we had a real economic downturn.
Okay, so you know what? We are now literally just in the first week. We're watching the market here. You know, we opened down a little bit. People have been wondering, when is this going to end? This massive rally. You know, how could it keep going higher, right? And I'm sure, I promise you, there are a lot of the forever bears who have been trying to short this market because they think it can't go higher. It can't go higher. One of the things we always teach at Wall Street Global is don't think. As a trader, thinking can be completely counterintuitive because you know what? Markets do what they want to do, really, in a lot of different ways. As we said, money on the sidelines, really good earnings, solid end of Q3. Coming into the end of the year, now we're talking about like September, August and September, there was no seasonality weakness. We did start to see a little bit of weakness in the economy and the jobs number, which contributed to Jay Powell's pivot in Jackson Hole to a interest rate cutting cycle, which we just talked about. And now with the blackout, we don't know what the information is. But before the government did shut down, we did start to see that things were weakening a little bit, and that was setting the stage for a couple more cuts, whether they're 225s or a 50 and a 25. Last year we ended up with a total of a 1 basis point cut for the year. Now, if things go 225s, we'll have cut 3/4 of a point, right? Maybe 1 point is so. But what seems important is what do we look towards 2026 for? And that will be interesting to see at the next meeting. What is the Fed's guidance going to be for 26?
Right. And when earnings start in full gear, from the big companies this Friday, and then more heavily into next week and the following week, their guidance will be critical.
Correct.
And obviously that a lot of the tech rally has been fueled by companies significantly ramping up their CapEx spending.
Yep.
Both because of their investing as much money as they possibly can in AI.
Yep.
They get much more favorable tax treatments than they have for
as part of the big bill.
As part of the big bill,
right.
Their tax treatment
is
go back to
the last one
unprecedented.
we did. We had a great,
and so that helps their CapEx spending significantly. But we also want to hear about from the banks the health of the consumer.
Correct. Right. The balance sheet of the banks is important.
And then we want to see. There was one big earlier this week. I believe it was earlier this week. There was one deal announced between two pretty significant regional banks, Fifth Third and Comerica.
Okay.
We want to see if maybe there's some more consolidation in the
regional bank sector,
regional
right,
bank
okay,
sector, which shows of really optimism for the future, for the near-term future from those regional banks. But then also just from construction companies, from heavy equipment companies, that what their orders look like going out into the middle of 26.
Right.
We know that the tech companies are going to be spending a lot of money, and that their CapEx spending budgets are way up. But we want to hear from other sectors of the economy what they're looking at going out into the middle of 26.
Right. That's really important because we know, look, we've been being pounded by the fact is, and look, to highlight something that's been fascinating is you've got Meta, you've got Google, you've got Microsoft, you've got Oracle. Obviously, that incredible day where Oracle had the largest rise in its valuation in one day historically. The biggest one ever was $427 billion by NVIDIA one day. It's an increase in capitalization.
Yeah.
A few weeks ago, it was part of the earnings, but it was more the fact that Oracle announced an amazing commitment to to putting billions of dollars into CapEx spending for AI. What's another thing to note, which I will say,
and we had a similar announcment early this week from Advanced Micro Devices.
Exactly.
Where it was up 30, the stock was up over 30%.
That was the deal that AMD did with OpenAI.
Right.
So look, we are in an environment. That's
it's
important to note.
We're in just a new. We're in a new phase. We're in a new phase. This is all new. This is a new phenomena.
Yes.
This is, some people are a little concerned about it because you'll hear this term circular investing, which means that all these big high-flying AI stocks are kind of investing in each other, and they're investing in the same, type of companies.
You know why they're doing it.
And if the music stopped, then would they all come down 25% overnight?
Yeah.
Look, we're not there yet. This is not.
No, we're still growing.
In December of '99, 3 months from the bubble, internet bubble
crash.
Completely bursting.
Yeah, totally.
Is it something to always keep an eye out for?
Right.
Yes, but we're not there yet.
When that was happening, right, you have to realize that
we're not in extra innings. We're in the second or third inning.
You said that the markets go up until they don't go up anymore. One component that is similar, the only component that was similar about every crash that we've seen, 87, 2000, 2008, and COVID and whatnot, before the crashes happened, we were trading at record highs. Crashes do not happen and have not historically.
We were trading at very, very high valuations. Even in 87, the PE for the S&P 500 was around 27. Right now, we're at about 23.
Right.
So we are not even as overextended on a valuation basis.
Yep.
With a much healthier economy than we were in 87 when we had that crash, which was really
insurance or technology.
Yes,
something
it was really
it's a fascinating story. Everyone should look into each one of these crashes had a very different catalyst, exactly.
Yeah.
Right. Obviously, we look. One was the internet bubble. Obviously, the '87 one was there was a technology and an insurance issue that caused that one, and then we obviously know that '08 was a predatory lending situation, and then there was obviously COVID. I want to talk to you about one quick thing because I saw SoftBank right? CEO of SoftBank went on the other day, and obviously, look, they've got their hands in everything,
Yes.
and they've been one of the biggest investors in startups and in all. They're on the cutting edge of the cutting edge.
Right.
And the CEO actually said that the NVIDIA, February 2023, NVIDIA was $108 stock. February 2024 was a $900 stock. It went to $1,200. It split 10 for 1, and it's now trading at 180 post split. He believes that NVIDIA, even at these levels, is undervalued. When asked why, he said, with the demand for AI and the chips and the data centers that the future is going to bring, okay, that and it is sort of living in a bit of a almost like not a bubble, but it's in like a dome. I mean, it's confined in so many ways.
Own world.
That's why the deals you talked about are. Why are these guys all making deals with their friends? Because they want to be able to control the dissemination of the chips and all. They don't want other people playing in the part. It's a bit of a monopolistic situation where if I know that I'm going to need these things and I can't make an exclusive deal with you, well, then I'm going to buy a little piece of you, so that I can guarantee that you scratch my back, I scratch my back. I want to guarantee the supply. But to think that the stock is undervalued makes actual sense. If you think about it, your first impulse is, I mean, oh my God, it's been the flavor of the moment. That's crazy. However, we know, as according to our man Dan Ives, we're in the second inning of a 9-inning game that's going into extra innings in the AI revolution. Trillions of dollars. It is the way of the future. We're not going to be hanging out with the Flintstones. We're going to be hanging out with the Jetsons. There's going to be a robot and in everybody's house within, and autonomous cars and all that in 5 years. In 5 years. So all that being said, you know what? We're in an amazing place as far as growth, as far as the economy goes, as far as the markets go, right? And so the future looks really bright. And, I don't think it would be fair to sit here and go, well, this can't last, because you know what? It can. Right, and as we said, it will last until it doesn't. But right now, with all of this, any pullback we've seen, rarely in my experience have we seen where the pullbacks have been as shallow as we've seen over the last number of months. Normally, markets go up, they go down. Normally, when markets trade at these high levels for long enough time, we normally see a pullback.
But we're at the beginning of a completely revolutionary, almost like a modern age industrial revolution.
Yes.
Where we're bringing technology that's going to change the world into all facets of life. Similar to
probably the railroad.
The railroad
in
the mid-1800s,
right, exactly.
the automobiles in the early 1900s.
That is what it is.
And we're just not to the point where it's almost over. That's not where we are.
We're not nowhere near that.
It's still percolating and developing and defining itself.
Yes. We are in the beginning stages.
You just have to enjoy the ride for right now.
The market feels strong. I think we're in a good place. These numbers are extraordinary. I don't think anybody could have predicted that when they came in. There were the naysayers about the new administration, about tariffs and all that. You know what? I was not a fan of all of that in the beginning, but I have to admit, at the end of the day, the new sheriff in town has lived up to most all of his promises as far as that goes. The support that we're seeing by the large corporations, and I know he wants to make America great again. He wants, look, you and I talked about it. If we kept poo-pooing the fact that we're building data centers, but that's 5 years out. You were the one who said it to me, Pete. Yeah, but you got to start building them now. The people are going to start going to work now. All of that infrastructure is starting.
They're not going to build themselves.
They're not going to, and they're not suddenly going to be built. It's going to take the 5 years to get there. And along the way,
that requires workers also.
All of it is employing everything, and so that is what is behind this rally. That's behind the fuel in this market. It's behind the fundamentals and the foundation. Just like when we opened an IPO here in New York at the NYSE, it takes 5 hours because you're building a building. You're putting the bricks in the right place. You're putting the mortar. You're using good equipment, right? The way we open an IPO here at the NYSE, will determine how the stock trades into the future. That's how this market and the economy feel. It feels like we're building it really well, right? And that's what's going to purport the way things look 2, 3, 4, 5 years down the road.
Yeah.
All right. You know what? There's not much more I got to say about that. We're in a good place. Tim is the best. Think about it. You know, you hear a lot of just like mainstream media talking a bunch of stuff that doesn't make that much sense. Tim breaks it down. This is the beginning of the rest of your life. Don't get scared. I know sometimes it's a little bit intimidating, but this is a kind of a market and an economy where you've got to dip your feet in there. Think about it. On that last day of Q3, $4.2 billion came into the market. That's a major vote of confidence of people putting money to work. Look, think about it. If today's high is tomorrow's low, you know what? Then you're making a good investment. I know people are scared about buying into a market that's been trading at record highs for a while because your fear is, oh my God, you know, I'm going to be the one who buys at the top. You know what? If you thought that way all year long, you've really left a lot of money on the table.
Yeah.
And we don't want to leave money on the table. We want to have a nice dinner, have a good holiday, and I love you all. That's all I got to say about that. Thank you, Timmy. Pleasure.